Ever wondered if you're paying more tax than you should on your rental income? This video will show you the real difference between the MRI and the annual rental income method with side-by-side comparisons and how to switch if it saves you money. A quick recap: what is the difference between MRI and the annual rental income method? MRI starts for monthly rental income and it's a final tax of 7.5% of the gross rent with no deductions. Annual rental income is based on the net income, that is your rent minus allowable expenses, and taxed using the graduated tax rates. Now here is how to know which option suits you best. Go with MRI if your rental income is under 15 million Kenya shillings per year, you don't have many expenses, and you want simple filing. But if you have high costs like the repairs and management fees, or want to carry forward losses, the annual rental income method might save you more. Now, who can't use the MRI? Not everyone qualifies for the MRI. You are not allowed to use if you earn rental income from commercial property, you are an non-resident landlord, or your total income is more than 15 million shillings per year. In these cases, you must use the annual rental income method, and if it's commercial rent above 5 million, you may also need to register for VAT. Let's look at a real-life case. You are earning 80,000 shillings per month, totaling to 96,000 a year. If your expenses are 400,000, here's how it plays out. MRI will cost you 72,000 shillings in tax. The annual method for expenses gives you a taxable amount of 560,000 and tax of about 82,000 shillings. So in this case, MRI is cheaper by 10,000 shillings. Now let's go higher. Assuming the monthly rent is 180,000 shillings, that leads to 2,160,000 shillings per year. If expenses total to 1.1 million shillings, your MRI tax is 162,000 shillings. But under the annual method, your taxable income drops to 1,060,000 shillings and tax comes to about 143,000 shillings. This time, the annual method saves you money. So for bigger rentals with high costs, it might be worth switching. Here are the pros and cons side by side. So for MRI, it is easy to file, fixed rate of 7.5% and no balancing required, but you can't deduct anything. For the annual method, it takes more effort, but lets you deduct costs and even report losses. If you track expenses well, then the annual option might give you better results. Want to shift or leave the MRI to the annual taxable regime? Here is how. Step 1. Write a formal letter to KRA explaining your reasons and include your PIN. Step 2. Attach proof like the lease agreements, receipts, and expenses records. Then go to the iTax account, head to the Help menu, and click Submit a Case. Upload everything and wait for feedback. Once KRA approves your shift, you will file under the annual rental income method from the next return going forward. Remember, you can't use both methods at the same time. So before switching, do this. Track your rental expenses properly, keep every receipt, and do a quick tax comparison. If the annual method won't save you more than the 7.5%, just stick to MRI. But if you are spending a lot on maintenance or management, then switching could reduce your tax bill. Which rental tax option should you choose? It all comes down to your numbers. MRI is simple and predictable, but the annual method gives you more control, especially if you track your costs. Always run the math before choosing. Was this video helpful? Tap like, subscribe, and share to support the channel. And check out our other tax guides uploaded every week.